Okay, good afternoon. This is Brian with NetPicks. Thanks for joining us today for our presentation. And we're going to be interviewing Mark Sebastian today. He is the author of the Options Traders Hedge Fund. And Mike Rykse, our resident options expert, will be walking him through the interview today. And we'll be getting started in just a few minutes from now. So with that, I am going to turn it over to Mike Rykse. As I mentioned earlier, Mike is our resident options expert here at NetPicks, and he's going to be taking us through the author interview today with Mark Sebastian. So Mike, it's all yours.
All right, great. Thanks, Brian. I too want to thank everybody for joining us here today. We do have a lot of great information ready to go for you. So to be honest with you, this is a presentation I've been looking forward to for a few weeks now. Anytime that I get to come in, talk about options, and to add to that, I get to pick the brain of an experienced floor trader. Yeah, that's something I really get excited about. So thank you to Mark for taking time out of his busy schedule to join us today. So welcome, Mark. To start things off, I'm always interested in hearing somebody's story. Everybody has a story, and what I have found in the past is just by hearing somebody tell how they got their start in trading, what their experience level is, there's really a lot of good information to gain from that. So, Mark, to start things out, what I'm looking for is just if you could give us some background info on yourself, how you got your start in trading, some of the products that you've traded, and how your experience on the floor has really helped you develop into the trader that you are today.
Yeah, I got when I was a junior in college, I was pulled aside by one of the professors that I knew pretty well. I went to Villanova. And he pulled me aside and said, hey, I'm starting this new derivatives course. It's going to be a lot of math, and it's going to be really hard, but I want you to take it because I think you're going to like it. And so I did, and I did. And that was actually my first real kind of touch with options. It was all theoretical, basically just covering conversion and reversal arbitrage, interest rate arbitrage between options and cash and futures and cash. And some of the other, theoretical things that you really don't do when you're a full-time trader. But that got me interested enough in options that I sat down and decided that I wanted to be a trader instead of getting into investment banking. I interviewed with a firm called Group 1. They still are, but at the time they were probably the second biggest independent market making firm out there. They're either second or third now. And I clerked on the floor of the American Stock Exchange for a year while I went through trader training at night. So every night they would school us in class or in mock trading, all sorts of different things like that. Then about 11 months later, they put me on a badge. I was in Cohen Duffy McGowan, which was General Electric, Philip Morris, Home Depot, Merck, a few other ones. Traded there actively. Well, I'm from Chicago originally. I moved out to New York, shockingly, because I was dating somebody. I'm sure nobody's ever done that before. So after she and I broke up, I took the opportunity to move back to Chicago and got in with an SPX trading firm. Spent a little time working the step on the floor of the SIBO. Working over on the CME, mostly spent upstairs being risk manager and doing arbitrage between S&P 500 volatility and Dow Jones volatility, along with a few other things. Liked it there, but ended up running into an old buddy that was still with Group 1. They offered me a job trading on the floor in Chicago. I took it, traded there for a few years, jumped to another firm. Around 2009, I was between firms. I was either going to go back down on the floor and trade, and I ran into a guy that ran an education service. He said, "Hey, you want to start working for me?" Sounded interesting because the way it was pitched to me was, we're going to teach people kind of the right way to really understand this stuff. Because I looked around kind of what is taught in the retail environment, and a lot of what is taught is go out and sell every month and you'll make money, which, sounds great, except for the fact that that's the most ridiculous thing I've ever heard in my life. And I thought that was not what this guy was kind of pitching, but it turned out that's what it was. I said, this is not the right way to do things. Started Option Pit, which is my education firm. We're now in the process of buying back into a market-making firm, starting a hedge fund, and eventually running a prop business as a secondary ownership vehicle, similar to. So we'll have Option Pit, the education business, then some sort of market-making business under the name Sumo Capital. What I would say about myself is that I am not a professional educator. I'm a professional trader that teaches other traders. And I think that is, I think that's how we wrote the book. I think that's the approach that I constantly take to what I do. I always see myself as a trader first and an educator second. And I teach people the way I would want to trade things. And so, we don't take a lot of shortcuts. And I find myself treating my students much like when I was at Group 1 and at Everest. I actually was one of the head trainers. So I would teach new guys coming in how to become market makers. And I take the same kind of approach. I'm happy to be your friend, but in the end, you're not hiring me to be your friend. You're hiring me to kick you in the rear and to teach you how to do this stuff right. So, I've traded so many cool things. General Motors, the old one, Best Buy, SPX, Dow Jones, General Electric, ImClone, PeopleSoft. I traded the PeopleSoft takeover, the ImClone takeover, the Clear Channel takeover, Novastar Financial. The interesting thing about GM, old GM, is that one of the things that we always saw, this was in 07 and 08, was we had guys just scrambling, and GM's trading $25. This is old GM's trading $25-$30, and we have absolute massive demand for the Leap 5 puts and the 7.5 puts. They would buy thousands and thousands of the 5 puts and the 7.5 puts in the 2009 and 2010 strike. Now, Mike, do you know? We eventually figured out who those customers were. Do you know who those customers were buying those puts? All right, well, think about it. Who would want to buy, with a stock trading 30, all right, even if you thought that the underlying was going to take an absolute tank, do an absolute tank job, would you go out and buy the 5 put?
I would not.
Probably not. No.
Absolutely not.
So now think about it. In 2008 and 2009, what part of GM, what part of GM actually probably had the highest return if you thought GM was going to make it? The debt. The debt. So if you bought the junk debt, you could buy junk debt for 60 cents on the dollar plus get the interest rate. So what we figured out was that there were those way out of the money puts were involved in junk bond hedging. So it was kind of interesting, and they were probably glad they did.
Yeah, no kidding.
So, anywho,
well, I think that's fascinating.
Trade. Yeah. So,
just hearing you talk there for a few minutes, it's fascinating to me to hear how a professional thinks. I'm working with retail traders all the time, and it's always on the, how do I pick direction? How do I do this? How do I do that? And to hear a professional talk about what they're doing to place their trades, it's just a different way of thinking. So I'm fascinated by that. So thank you for sharing that.
Yeah, well, I think that it behooves all retail traders to try and think like a professional. Otherwise, if you're not thinking like a professional, you're going to be doomed to making retail moves, which is selling the bottom and buying the top. And the other thing I would stress is that more so, even with directional bets, you will find that a firm understanding of volatility is going to be the number one thing that determines the success of even your directional trading, and certainly non-directional trading. Yeah,
and I really got that from reading your book, and I want to come back to that here in a few minutes
Sure.
because it's such an important topic to cover. But what I want to talk about next is, now that you're on the retail side of things, it sounds like you're starting to get back into, possibly the hedge fund arena. But since you're on the retail side of things right now, how is trading different for you on the retail side of things as opposed to trading on the floor of the exchange? And
that's a great question. When I first got off the floor, I felt very dyslexic. Does that make sense?
Yeah, I've heard that one before.
Yeah, I was so used to trades coming at me, not being the initiator of trades. Now, you end up as a professional learning how to initiate trades in some ways. You're always manipulating the bid-ask spread. And when I say manipulate, I don't mean like rejiggering it in your favor, but you're moving it in order to try and stay as flat as possible. Because we always said the best position was no position. As I figured out how powerful a weapon the ability to truly initiate is, I've learned to take all of that knowledge of floor trading and kind of market behaviors, volatility behavior, to really step in and initiate trades. And it really allows me to be smart about it. So, I find stocks where I think volatility is cheap, and then I'll sit there like a lion in the woods, and I'll wait for some big house to come in and start buying buying premium, and then I'll jump in and piggyback, and I don't have to worry about an existing position. That's really the powerful tool. Then on the sell side, selling premium, I'll look for expensive volatility, and I'll wait for somebody to step in and start selling some volatility, and then I'll jump in I'll pounce like a lion and go in and try and sell premium. And that's really, you can find that even in things like the S&P 500, where, we've seen volatility this week get bid and bid and bid. I don't know if you've noticed, but VIX and even more so, real S&P volatility has been up 3 days in a row. It was up Friday, Monday, and Tuesday. The VIX wasn't up Friday, but S&P vol was. And so, if you stepped in Monday afternoon, you're sitting pretty buying vol. Believe it or not, you've been basically able to get free gamma out of it. And now what I'm doing is waiting for somebody to step in and start selling some premium, and then I'm going to go in and sell premium. I'll do butterflies, condors, vertical spreads, all of those. I think one of the keys is, and I think this is that retail traders make all the time, is that they don't wait for somebody much bigger than them to make a decision. They try and kind of force the issue, if you will. Does that make sense?
It does, and I'm glad to hear you say that, because that's really what I wanted the audience to hear today. It was definitely good to see that uptick in vol this week, and I took advantage of that in a few trades here on Monday. Have you found that technology has evened the playing field? I mean, with some of the strategies that you just talked about, with the tools that we have access to on the retail side of things these days, does it make it more of a level playing field for us on the retail side?
The interesting thing is that a lot of the stuff that the brokers actually wrap into their software is absolute junk. But there are some great retail products that you can get out there. Just unbelievable products. But unfortunately, most of that stuff you have to pay for, just like a market maker does. Here's a question for you. How much do you think, we were looking, before a market maker makes a single trade, what do you think his monthly nut is? How much do you think he needs to clear before he actually can pay himself in a given month?
Are you talking the price of the seat included?
The whole 9 yards. The seat, his technology, his access fees, this, that, and the other. How much do you think?
I'm just going to throw a number out there. I'm going to say 50,000.
Well, all right. It's not that bad. But it can be. If you're a market maker trading on two seats, so you're probably trading SIBO and Philex at the same time. So that's $10,000. Then you've got all of your different quoting platforms. That could be another 10 grand. Then you've got all of your fees, your licenses, this and that. And so you're looking between $25,000 and $30,000 out the door. And that's not including his cost of commissions on his trades, his payment for order flow, all that other junk. By the time you're done, the monthly expense is closer to 50 grand. You're right. But his just actual nut. Now, there are some stuff that look cool that aren't that great. For instance, I'm not gonna name any brokers, but many brokers do not properly price volatility. They don't account for dividends, they don't account for this, they don't account for that. Well, if you're doing volatility analysis and you don't have, the right things to do analysis on, then you're gonna have some problems. Now, if you're just a stock charter and you want to look at candlesticks or this type of stuff, yes, the technology out there is great. But if you're looking at options themselves, in terms of the stuff that is given to you free, I don't think the playing field is that level. Now, if you're willing to spend a few $100s a month on some good technology, some good vol analytics, yes, absolutely. You can, I spend about, I get stuff given to me for free. Sorry, folks, I do. But
it must be nice.
Yes. But I have about if you were to add up what it would cost somebody retail out of the box with no discounts for the stuff that I use to analyze every month, it'd come out to under $1,000 a month, be maybe $500. But because I have the ability to initiate, I don't have to take trades. You will pay for good vol analytics and good trade analytics. You'll pay for them within a couple of days. People are so penny wise and pound foolish in the retail industry. They'll complain about their commissions, but not pay attention to their order routing. They'll, they won't pay $250 for something that'll make them $1,500. They won't buy back nickel options, which is the single dumbest thing that you can do as a retail trader. It's such a retail move, and I hate to keep saying that, but this is when I teach a lot of retail traders, and when I'm working with retail traders, if they're doing something that is silly over a couple of pennies, I call it a retail move, because the guys I'm working with are primarily retail traders, but they want to think and pay themselves like a professional. That's the key. What makes a professional trader? Somebody that can pay themselves to call themselves a professional trader. And if you want to get there, you got to think like one. So it's a very retail move to not buy back options trading less than a nickel. It's like, what's the old saying? Picking up pennies in front of a steamroller.
Yep.
So, the single, I've all of my major big money days where I made 6, 7, now I've never had a 7-figure day, but I had several days where I made high 6 figures on the floor. And every time that happened, it wasn't because I was trying to make something happen. It was because I stayed long, cheap options, didn't get rid of them, and covered all of my nickel options. And I woke up one morning and a stock had moved $30. All of my big days have mostly been dumb luck. But dumb luck that I created by not being open worthless options. So, if that makes sense.
Yeah, that definitely makes sense. And, I would agree. I've definitely seen that with some of the traders I work with as well. Would you say
you'll find Mike, in your training, you'll find that that's a great way to get somebody on point, is to say, what a retail move. And they'll be like, hey, and then all of a sudden they'll kind of see what they're doing. It's a good wake-up call.
Sure.
It's like, I'm trying to think of a good analogy. It's Oh, it's like calling somebody. It's like calling a first baseman pulling a Bill Buckner move, if that makes sense.
I like that one. Being a sports fan, that definitely sinks in. So I like that. Well, let's get into some of the specifics of your book. I had the privilege of reading it here over the past couple of weeks. For those people that are listening that are not aware of the book, the title again is The Option Trader's Hedge Fund. Highly recommend picking it up. There's a lot of useful information in that book. And the basic premise is to start trading using an approach similar to as if you were an insurance company. So basically, instead of buying options like most retail traders start out doing, we're talking about selling premium and using option strategies to collect that consistent income. So, Mark, for a trader that has never experienced that or they don't have any experience with those types of trades, where's a good place to start, other than buying your book, of course?
Well, and actually, I wouldn't buy my book to start, to be honest. My book is a great kind of third generation book. I put it in the once you've read the solid, nuts and bolts book, then my book is the next one that you should read. So the first book for, if you just want to start by really learning options, CBOE Option Institute has a lot of free. I don't love some of their paid stuff, but their free stuff online is great. Then Mark Wolfinger has a good book called Options for Rookies. It's a good place to start. And Shelley Natenberg's book, which is called Option Volatility and Pricing, or is kind of the Bible of the industry. Another good nuts and bolts book is Jim Bittman's book, Trading Options as a Professional. Then move into my book. That's where I would really start. Those books. Now, I offer some resources at Option Pit for about the price of a book that are really, really good kind of starters for understanding options. But you would do that versus, reading Mark Wolfinger's book.
Okay, so that definitely makes sense. So with this whole idea of collecting premium, for the retail trader, it really takes a shift in your thought process. I mean, you have to take yourself away from just focusing on directional strategies and really focusing on looking at volatility. And is it a fair statement to say that in order to trade options as a business, you really need to start out mastering how to read volatility on the products that you trade?
I would say in order to trade options at all, you need to master volatility. Even from the long side, I'm sure this has happened to you. Last Apple earnings, did anybody buy the Apple or the Apple 5? Think Apple was going to drop, buy the 570 puts, and Apple dropped to 574, and those puts, the 570 puts, actually lost money. Well, that's all volatility. So I would say that before you trade a single option, master volatility. Then, at that point, then you will be ready to start selling premium. One of the things we found is that, and this is, again, how we teach and how the book is written, is that if you lay a really strong foundation of understanding of how options actually function and how to trade and how they price, how they move, how volatility works, overlaying strategy is actually really easy. It's that fundamental understanding. It's like anything, any specialty. Mike, did you prior to being in options education, what did you do for a living? If you don't mind me asking.
I actually started trading when I was in college.
Oh, nice.
So I've actually done this ever since. I've been doing it for the last 10 years almost. So really, I've had.
All right. Well, your dad. What did your dad do, or your mom?
My family owns a restaurant. We're in the food industry.
All right. Perfect. Okay. Now, before your parents owned a restaurant, right? or before they took over ownership, how much time had to be spent doing the dishes, working the kitchen line, working the front desk, working this, working that, before you actually started running the actual business. Hours and hours and hours. If you were going to take over the family restaurant, I mean, how much time would your parents make you work in the restaurant before they even thought about letting you run it?
Oh, we're talking months or even years before
Right.
you really grasp it.
Exactly. Options are much the same way. And so if you're, and especially, when I was a market maker first coming out, so I was trading somebody else's money. You're trading your own money, and you're not going to have a firm fundamental understanding of the products you're trading. Once you get that firm fundamental understanding, that's when you can decide, hey, I want to run an Italian restaurant, or I want to run a French restaurant, or I want to add this to the menu. I want to take this off the menu. I'm not going to ask what kind of restaurant is it, if you don't mind me asking.
It's a family restaurant serving just typical American homeschool, home cooking, mom's home cooking, that type of food.
Nice. So, but before you're going to add mac and cheese to the menu, you need to know, okay, what kind of noodles do I want? What noodles go in? What sauce? How am I going to make the sauce? Is there anything I can do to the sauce that would make it maybe work a little better? Anything like that. That is the way options work. Understand what goes into those options allows you to optimize how you trade those options. And so, yes, I would say in 10 minutes or less of answering what should have been a two-word answer, yes, you got to know volatility before you sell premium.
Okay, that definitely makes sense. And one of the topics that I really found interesting in your book was when you talked about trade selection, because it's when I teach students, when I sit in on these webinars, it's just a topic that comes up all the time. I'm constantly being asked, how do I select my trade? What's the process that I go through? And I thought you did a great job of simplifying it into 5 steps. And those 5 steps are market selection, strategy selection, time frame, volatility, and pricing. And what I found very interesting is nowhere on that list do you say anything about picking the direction of the product.
Right.
And I'm sure it's on a list, but it's probably pretty far down on that list.
Yeah, well, that's kind of, strategy. That's where under strategy selection, you'll find it in there, but it's a subset of that. And I think that's a really important point. Is that you need to know, most often, as I said kind of at the beginning, being right on direction is kind of third on the list of what's going to make your directional bet a winner. Especially if you're selling vertical spreads.
Yeah, and I think a perfect example of that is just going back to, you mentioned the Apple earnings, and it's a perfect example of how you can be right on direction. You can be perfect on that. But when it comes to earnings and you have that vol crush that comes in,
yep,
you can be right on direction, you're still wrong. You still lose money. So, and that can be extremely frustrating and difficult for a newer options trader to understand. So I guess my next question would be, do you use any technical analysis at all with your trading? It just seems to me when I talk to floor traders, either current floor traders or former floor traders, they're not big believers in technical analysis. But do you find any benefit of looking at the charts before you're going ahead and placing the trades?
Well, I do a lot of technical analysis of volatility. So I look at vol charts, any directional bet I'm taking or non-directional, I pay very close attention to vol charts. And then, I think that it's ignorant. I don't really think the technical analysis is that great. It's not something I really rely on. But what I would say is that ignoring technical analysis, I think, is also dumb, because so many people pay attention to technical analysis that in some ways it is a bit of a self-fulfilling prophecy. I used to say the only reason why technical analysis works is because people believe technical analysis works.
Exactly.
But there is something to be said about that. And that's really the key. So yeah, I pay attention to kind of very basic, strong support and resistance levels. And so, especially on directional plays.
And I wanted to ask you about that. In your trading currently, are you playing mostly volatility, or do you find yourself giving your trades a directional bias while still playing the volatility plays?
Yes and no. Yes, I mean both. I trade a lot of VIX. I trade a lot of VXX. I trade a lot of non-directional SPX. One of the trades that Dennis and I do a lot, we call it almost a synthetic condor. And it's a great trade. Dennis runs a hedge fund. He's my co-author. He was one of my first students that at Option Pit, and I basically helped him build his hedge fund. And he does what we call synthetic condor. So what he does is we'll go out and find a grouping of stocks that he kind of likes, where he thinks volatility is a little expensive, and he'll sell premium in the form of put spreads, out of the money put spreads. Then he'll find stocks that he doesn't like, where volatility is also relatively high, and he'll sell out of the money call spreads. And so what that ends up being is a directional spread, but when you put the whole trade together, it almost looks like an iron condor. But yeah, I think that there's always opportunity in directional spreads, but I find myself doing a lot of butterflies, a lot of directional trading via VIX and VXX as well.
Okay, that definitely makes sense. And as long as we're talking about some different types of trades, you mentioned there's really 5 types of trades that you really need to master, really have in your tool belt as an options trader. And you mentioned vertical spreads, iron condors, at the money iron butterflies, calendars, and ratio spreads. For the newer trader, where's a good place to start? Do you have to have all those down before you put live money on the line, or can you master one at a time? Say, I'm going to take a couple of months. I'm going to master the vertical spread in live market conditions, and then I'm going to move on to the next type of trade.
Well, I would say that yes and no. If you lay yourself a really strong foundation and really dig in, make sure if you understand what you're doing, spend all that time on vol and on option structure, and then break down each thing. I think that's a really smart approach. I do, but you can't neglect that kind of introductory knowledge. So you can't just skip right to vertical spreads and say, I'll fill in the rest. But you can say, okay, I've really built a nice foundation. I'm going to start by trading directional vertical spreads to try and see if I can do that well. I think that makes a lot of sense.
Well, the reason I bring up the vertical spread, because it seems like there's so many different combinations of trades that you can put on, and it just seems like when you break them down, the vertical spread is at the basis of a lot of different types of trades. So if you can master that one, you're setting yourself up for success long term. That's why we let it off.
I agree. I think the vertical spread and the butterfly are the two easiest trades to really the two really easiest trades to get a strong understanding of. Then followed by the iron condor, and then the calendar, the time spread. That one, it done properly can be a great trade, but also needs is probably the most nuanced, along with the back spread and the front spread. So those ones are much more nuanced than I think. Single month spreads. As soon as you move from a straight, spread into a spread that involves term structure, which is how we describe how the different months are related to each other. We call it term structure. That is when you start getting into some pretty complex things.
Sure. And for me personally, I found myself trading calendars much more frequently a number of years ago. I tend to, I trade more vertical spreads, more iron condors here of late. more so than the calendars. I just, for whatever reason, the calendars is just not one of my favorite trades to put on.
The key is that you have to be very patient.
Exactly.
But so the neat thing about a good calendar spread is that it can be the shortest duration trade if you execute it well. But you have to be very patient. You can't, more so than any other spread, you cannot force the issue on a time spread. You really have to pay attention to the setup itself. I tell people always say, Mark, can you teach me how to do adjustments? Adjustments. Yes, I can teach you how to do adjustments. You know what the number one adjustment you can make is learning how to put on a good trade. And then you'll never have to do a lot of adjustments.
That's a great point.
And more so than any other spread is the time spread. So,
well, that's pretty interesting. I mean, if you look at the market so far this year, it's been a pretty interesting market. I mean, we've been stuck in a pretty slow moving market here so far this summer. A lot of tight ranges, a lot of low volume. What types of trades are you finding success with in this current market environment that we're seeing?
I've done a lot of butterfly trading, a lot of vertical spreads. I have what my favorite directional bet play is to do? I've actually found works like clockwork. I screen for stocks that are trading at their absolute 52-week, where the options are trading at a 52-week low volatility. So I'll show you this actually. You want to make me present it real fast?
Yeah, let me see if I can do that. All right, it should be on your side at this point.
Mm-hmm. So this is a little product that's called LiveVol that I use. And what I'll look for is options that have their implied volatility at a 52-week low. All right, so let's see if we can find anything interesting in here today. All right. Let me know if you see anything you want to trade that looks interesting. So let's look at Real America. This could be an interesting one. It's got a corporate takeover, that's why. WMC, Western Asset Mortgage Corporation. Here we go. Must have just had earnings. Vol's getting destroyed. Just got listed, so that's not a good one. So, folks, write this down. This is top-notch stuff. People pay good money to see this. Well, let's look at Quigen. I don't think they're in a buyout, are they? No corporate action. All right, now, and so the options are trading at a 52-week low. All right, so they're super cheap. All right, 30-day vol is at 22% implied vol. All right, so let's just look at the vol. Here's the vol. Certainly moves around. Dirt cheap. Meanwhile, the stock is trading right at a 52-week high. Also, super cheap, right? So, what I will literally do is I'll go out to the September contract month, and I'll just buy. I'll go in and try and buy a call. Well, this one obviously trades by appointment, but I would go in and try and buy like the 17.5 calls. This one's not a great example. We saw a similar example in like Merck a while back. And in Google, actually. This was a great one. I'll show you this. So here we are with Google. And right here, the volatility got absolutely oversold. This was July 20th. So which was not the exact day after earnings, but it was, I think there was one other day mixed in here. but they absolutely crushed the vol. So, and Google was up. You could come in and buy the August 620 calls, which had $22, 22 days to expiration for about $8.50. So I literally went in and said, hey, let's buy. I actually did the 6 1/4s for $6.70. Okay, how are those looking today? How are my OG 6 1/4s looking today? Not such a bad little trade.
No, I think that's really interesting what you just did there. So really, with that type of play, it just seems like earnings season would just fit in perfect for you then, just to come in after that vol gets crushed on earnings and just look for those trades like that.
Yeah, look for vol when it gets completely oversold. We saw that, I mean, Apple was another one. On both times where Apple vol, and for those of you who don't have this 52-week vol thing, one thing that you can do, the SIBO has these great indexes. I'll show you this, VXGOG. It's basically the VIX of Google, and you can see again that vol getting completely oversold. It was right near 52-week low. Apple, which is VXAPL, we actually saw the same thing. I think Apple's getting set for a $100 move. We saw the same thing. The last time Apple vol got this cheap was in early February. What happened to Apple right after, let's say, February 4th? You guys remember? I'll show you. So this, you could have bought calls at the cheapest price in the history of Apple on January 31st. How do you think that trade would have worked out for you?
That was an amazing run. That was a fun move to.
You would have made
watch
an absolute killing. The straddle was trading for $20. You made a blasted killing. So anyway, I don't remember how we got onto this, but yeah, I do pay attention a lot. Hey.
Well, I was asking you what trades were working well for you in the current market environment.
Yeah, I mean, so finding overly cheap vol, finding overly expensive volatility, buying and selling it. I do a lot of trading in VIX options. You have to have a really strong understanding of VIX itself, but that's probably my most profitable trade. If you're not trading in commodity options right now, you are missing the hottest trade in the business. One of the things about actively trading is that you will find that there are some great opportunities to trade. You'll find really great opportunities. And right now, the number one crazy thing going on right now is soy and corn. The implied volatility on corn options and soybean options are insane right now. And, Techram Corn Fund, which is a really good ETF, actually, actually does a decent job of tracking corn, is the vol's through the roof. And there are all sorts of, you're looking for a place to sell premium. August put spreads in corn make a ton of sense because I'll tell you, Mike, where are you located?
I'm in Michigan.
Oh, okay. I was just in Michigan.
Interesting.
Yeah, I was in a town called Sturgis on a lake, but driving through Chicago, the Chicago, Illinois area, into Indiana, and into Sturgis, you pass a lot of corn. It is cooked. Absolutely cooked. Corn, especially if the dollar keeps rallying, could go to $9 a bushel.
Yeah, and I think it's an interesting play because a lot of people don't think about those, those commodity ETFs like a corn
Right.
to go.
Well, most of them stink, but this one's pretty good. And then the more interesting thing is, all right, so let's say we think corn's going to $9. Well, that would put this corn probably near 55, maybe, probably $56. But who buys corn? Coca-Cola, McDonald's, Tyson Chicken, Yum Brands, buys chicken from Tyson. So take a,
go in the grocery store, and 3 out of 4 products in the grocery store they use corn.
Using corn, or soy is the next one to go. Soy's the next one to move. Now we get another week of no rain, soy's going to cook too. You're going to be enjoying a lot of burned edamame. So where Michigan are you?
I'm actually about 20 minutes from where you were at. So
you're kidding me?
I'm actually in Kalamazoo.
Oh, nice. I love Kalamazoo.
Well, just looking at some of the trades that you're placing, you're talking about looking for plays on volatility. For people that don't have these scanning tools, this is why with a lot of the students that I teach, I really preach the use of a pretty small watch list so that you can be familiar with the products that you trade. If you arm yourself with those different strategies, if you've got 4 or 5 different strategies and you've got a watch list of, let's just say 10 to 12 names, you're always going to have different opportunities there. So
yes,
for me,
I think that makes a lot of sense. As long as your students understand that cash is a perfectly acceptable position. It's better to have no trade on than a crappy trade.
Agreed. Yeah, I definitely agree with that. And there's definitely periods of time where I am sitting on hands because it's, when we're taking these positions, I'm not worried about frequency at all personally. I mean, I'm not day trading here with these types of strategies.
I actually think, wait a minute, I'm 100% certain that we put that blog into the book. Why are traders hands so hard to sit on? I believe that was one of the
it's in the book. I do remember that.
Gamma scalping. I know it's in the book. I'm just trying to find it.
Yep, and I agree. It's the hardest thing in the world for a trader to do because we all feel like we have to be active all the time, and it's just not the case.
Yep. And it's super important. It really is. Here we go. Yeah. Why are option trading hands so hard to sit on? Once I've been working with an options mentoring student for a little while, they can usually figure out how to properly set up a trade. I'm going to read this little excerpt if you don't mind.
Go for it.
That is about half of the battle. The next step is managing and adjusting. This is where I can run into problems. Most of my students get the way to adjust and can even understand the when. It's the when not to that seems to kill them. Here's a DIA position that we are currently working on in the AM report. And it shows a nice graph. Looking at this position, does it need an adjusting? If so, what should I do to fix this position? And then the answer is, if your answer was anything besides no and nothing, you may have a case of over-adjusting disease. And then I get into, over-adjusting. But the same can be true for, deciding not to trade. The decision not to trade is as powerful or more powerful than the decision to trade. More money has been saved not trading than made trading by the retail public, in my opinion. So there you have it.
That's definitely interesting. Just to kind of build on that, I personally have my list of go-to products. Like for me personally, it's Apple and IWM, SPY. Those are markets that I've traded forever. I know them inside and out. Do you have your list of go-to products that you trade constantly?
Yeah, I mean, VIX, by the way, and if you're not trading the VIX, you need to. So few people really understand how to properly price it and how it should trade. It's like it's hard not to be profitable in that product. SPX, Apple, Google, right now, corn, There's a few names. Facebook, kind of all the ones you're seeing here. VXX, XIV. There's like a whole host of products. But I am always constantly trying to find, I've got my core list, but I'm always trying to take names off and add names on. Does that make sense?
Sure. Yeah, absolutely.
You need to. It's important. You get married to a core list of names, you will eventually, trading dries up in names. Like Apple at some point in time will stop being such a great product to trade. It will.
Sure. I completely agree. And that's why on my watch list, what I train my students to do is have that core list, but always keep a couple of spots open. I just call them wild cards, for lack of a better term. For names that, if different sectors are heating up, just like if you're talking about corn or soybeans, some of the commodities, you have those names that you can go to kind of fill them in on your watch list for the next couple of months. We're not talking about long term, just for those quick plays. So I definitely agree with that approach. The next thing I want to talk about is you talk in your book a lot about portfolio protection, and specifically for those black swan events, the events like the flash crash, and we all know about the headline risk out of the Eurozone. And you talk about the use of units when protecting the portfolio. Can you expand on that a little bit? Explain what you're talking about and how you use that.
Yeah, well, I think in two ways. A unit is a cheap option that essentially you're throwing money away every month. You really are. A small amount, depending on where the volatility is, VIX. You're gonna add more or less of these cheap options where the market does not properly price kind of a major move, if you will. So, here we'll look at SPX. And we're going to look at let's look at a 1-year chart. We're now right at the last time our units really made a lot of sense. And, let's just go here. We're going to go a little further back in time. We'll go to kind of, so here we are, July 21st. Where was the VIX trading at that point in time? So July 21st, you've got the VIX trading 17. Pretty cheap, about where we are now, about where we are now. All right. Let's say you say, okay, I don't think we're going to have any problems here. All right. I think the market is good. We're good to go. I want to put on, I want to get short, a butterfly or a iron condor or a strangle, or I want to sell a bunch of vertical spreads in the SPX. All right. Well, that's great. That's great. But vol is cheap. All right. Which means that your vertical spreads are going to be closer to at the money. Your iron condors are going to be closer to at the money. Everything is going to be closer at the money. All we kind of point toward is, go into the, let's say you're doing a September iron condor. Go into September, and if you sell, let's say, 10 iron condors, and you collect, I don't know, let's say $2,000. All right? Spend $200. 10%. When the VIX is cheap, spend $200, 10%. So if the SEP 1,100 puts, just buy one, one of those is $200. All right? So if you did a 10 lot where you collect $2,000 on an iron condor, what is your, on a 10-point vertical, what is your maximum loss? $8,000, right?
Yeah, absolutely.
Right. You do a 10-point vertical on both sides, you collect $2,000, you're risking $8,000. You spend $200, so now you're risking $8,200 to make $1,800. loose odds a little against you. But let's look at where things are on August 8th as the market is absolutely blowing up. You know, your iron condor is probably down. On that 80-point move, your iron condor is probably down $2,000 to $3,000. But your put is now worth, that you paid $2 for, well, that's not right, is worth $40. So you're probably either a net wash or a net winner on the whole thing. You may be down $6,000, but with that one put, or you may be down $4,000, but with that one put, you're probably flat to even. Now, what do you do at that point? You have two options: unwind everything, or sell out of your insurance and take the risk. You know, the one issue you have is once these things work, you have to do something with them. Because the next day, we rally $70.
Sure. So if you get that quick move like you're looking for, you have
to take action. You can't just sit there with your legs shaking. It's very important. Yeah, because you give up a lot of money. So, sorry, what are you saying?
Are you talking about protecting individual positions here, or are you talking about
protecting the portfolio? You know, well, in that case, the portfolio was one iron condor, but you know, generally speaking, the cheaper the VIX is, the more you want to own some cheap puts. You know, generally speaking, with the VIX around 20, I'm looking to hedge with maybe 5% of my credit. So if I'm short, let's say $10,000 of premium, I want to have $500 of insurance with the VIX, you know, call it, you know, in the 18 to 20 range. When the VIX gets below 17 into the 16 range, then I might start ratcheting up to 10%. So the cheaper the vol is, that's when you want to start buying things. It's interesting. Volatility is at its most overpriced when vol is cheap. That's also when people get blown out. You know, when do you think people lose a lot of money? It's not when vol is high or low. It's when vol moves from low to high.
Exactly.
So you've got to be on top of that. So, yeah, I think that they're a very important aspect. So I at any given time, you know, if you're going to be short a lot of premium, especially with a relatively low VIX, you should be buying insurance. Sure. Otherwise, you're just setting yourself up for disaster.
And I agree. And like I mentioned, you know, we have all that headline risk in this market that, you know, there's just so many unknowns. So I definitely agree. That's an important part of your trade plan, that you really need to make sure you have that in place. And, you know, as long as I mentioned trade plans, you know, you had an interesting part in the book on trade plans, and it's a topic that I personally believe is the reason why 99% of traders fail, because they don't have a plan in place. And oftentimes when I talk to retail traders that are struggling, in most cases, they don't have a plan in place. And what they're waiting to do is they're saying, okay, I'm going to wait till I'm profitable. And then once I prove to myself that I can do it, then I'm going to go do the hard work and create that business plan and trade plan. And I think you said it really well in your book when you said having a plan is not a prerequisite to starting a business. However, having a plan is usually a precursor to creating a successful business. And so many times the traders get that so backwards. So
absolutely.
What are some of the things that you're looking for in a trade plan? What does a trader have to have in that plan before they put that live money on the line?
Well, I think that, you know, it starts with goal setting. You know, what are you trying to achieve? Then, you know, what kind of capital do you have? All right. Then, based on what you're trying to achieve in the capital, is what you're trying to achieve realistic? All right. Then from there, assuming that you've got a realistic goal, then how are you going to break up that capital and shoot for specific returns across trades? How are you going to break up your best available trades? All right. How are you going to allocate your capital? Good conditions, great conditions, awful conditions. Based on what you see in front of you, where does your capital go? And then based on where that capital goes, how much goes into each trade? It's almost a waterfall, if that makes sense. So that's really what goes into our
I think
trading.
a big part of that is okay. Yeah, that definitely makes sense. And I think a big portion of that trade plan has to be position sizing and risk management. Yep. And you talk about keeping that risk to 2% of your account per trade, and that's something that really lines up with what we teach at NetPicks. But for the smaller trader, for me, a lot of retail traders that I see start out with that $10,000 account, so they don't have a ton of money to work with. How are they able to keep that risk at 2%, but still put on enough positions to really capture that income and capture that premium?
Yeah, well, that's a good question. One of the things I'll comment is that, you should never treat any money differently. All right. One of the fatal flaws people run into is they trade $10,000 recklessly and then think that they're going to be able to trade $100,000. What you should be doing then is, on a $10,000 account, you may only put into action $5,000 to $6,000, and that may only build across, that may build across 8 trades where you're picking up $100 a trade. But you know what? You do a good job and you pull in, let's say 5% a month. The next month you're trading $5,250 or $6,000. And then you can slowly ratchet up that size. But you should never treat money differently. One of the big, the guys that don't really give a crud, what they'll do is they'll show you all this return you can get on a $10,000 account, and without any acknowledgement of the mental aspect of trading 50,000 versus 500,000 or 5,000. And there's a huge difference. So if you put yourself in the mind frame of a professional from day one, you will really set yourself up for success.
Okay, great. Yeah, I think it's great advice for the people out there that are just getting into options. I know we have a lot of
a couple $100 a month. If you take a $10,000 account and you can make $400 a month on, that is incredible return relative to a hedge fund, relative to whatever. I mean, think about it. What does $400 buy? A lot of things, over a given year. What is that? That's $4,800. $4,800 will buy you, here, I'll show you. See what $4,800 will buy.
No, and I definitely agree with you. I think what we run up against here in the options education is you've got people out there that are trading Forex and futures where, you can experience those high percentage returns, all the marketing that goes out on that. That's the battle that we face, is that, those returns aren't always realistic. If we can just get in and get those small singles and doubles over time, you are definitely going to be around for the long haul. You're not going to blow out an account like so many traders do over and over.
Right. And futures traders blow out accounts all the time.
Yep, it is. It's
that's an amazing. It's so easy to lose money. All right, so let's think about this. All right, for $4,800, you could get a 2002 Pontiac Grand Am. You get a 1998 Jeep Grand Cherokee. Oh, look, a 2001 Chevy Malibu with 144,000 miles. Hey, who doesn't want a 99 Ford E150 Econoline?
Throw a computer in the back of that and trade from there.
There you go. Hey, I wouldn't mind a 2001 Nissan Pathfinder or a Dodge Ram. That's a nice looking Dodge Ram, $4,795. And so, I mean, I think when you put things into the perspective of a car, people start to realize, hey, you can do really well. And yeah, you know what? The issue with futures, and is that you can run into a margin call quickly, and it's something you have to be very careful of. Futures are now here's a winner. A used 2001 Ford. It's the ZX2 Escort. So this is the souped up Ford Escort. Who wouldn't want that? Look at that beauty.
Oh man, it's a great way to put it in perspective. So
look at that.
Good example there. Look
at that beautiful. Oh, look at this. Look, the odometer goes to 120. Or do you think that's kilometers?
You can probably make it back to Michigan in that thing. So
yeah, plush interior.
All right. Well, I want to make sure, Mark, we have some time for some questions here. So if you don't mind, we have a few questions coming in for you.
Sure.
We talked about your recommended reading list earlier. We had a question asking, can you repeat those just so they have a reference?
Well, they're actually in the back of the book. Wolfinger's Rookie Guide to Options or Trade. Actually, if you want to get serious, start with Trading Options as a Professional by Jim Bittman. I think that's a pretty good book, and that'll really get you started. Then move into option volatility and pricing. Those are the kind of that's the Bible of the industry. Two Bibles of the industry.
I agree. Option volatility and pricing. That's one that I've had to read over and over again. It's just it's like the Bible of options trading. There's just so much good information in that book. So I would agree with that one for sure.
Mm-hmm.
Okay, so we had some questions on if you could walk through a few trade examples using some of the step-by-step criteria that we talked about. You've already done that.
By the way, my book does, just an FYI, my book does come with a free month of my Option Pit Live service, so you can listen to me yap for 45 minutes a day for free for a month. I think it's on page 202, Appendix C. Comes with a free month. So
and that's just optionfit.com. Is that correct?
Yep.
Okay, perfect. We have a question coming in on. They're looking for advice on how to trade VXX, how to trade some of the VIX products.
Yeah, I mean, you really need to understand the term structure of the VIX futures to trade VXX and VIX. I would read Russell Rose's Trading VIX Derivatives. Also, I did a series. I've done a couple of free webinars on VIX. If you shoot me an email, mark@optionpit.com, my assistant Anna can send you links to those vids. But I do a lot of stuff on VIX. But yeah, you really need to understand the term structure. That's the most important part. VXX, more so than any other product, the near term is determined by the near-term path dependency is determined by volatility. The long-term path dependency is determined by the term structure of the VIX futures.
Okay,
if that makes sense.
Yep, absolutely. So hopefully that helps you guys out, those of you that were asking about the VIX. And Mark, I'm actually going to take back over the
okay, that's fine.
Center here. So I'm going to take back the screen. Hopefully that's coming up for you guys. All right, so at this point, we are past our hour mark. So I want to thank Mark for joining us today, taking time out of his busy schedule. A lot of useful information here today. We did have some questions on some of the specific steps and some of the specific strategies that we covered. I would highly recommend that you guys go pick up Mark's book. Again, the Option Traders Hedge Fund. A lot of useful information in there. Just go ahead, head on over to Amazon, check it out. You will not regret that one. So I want to thank Mark again for joining us. Thank everybody for chiming in. And for those of you that are still with us, let me pull up. We do have another webinar coming up first week in September. So we are doing another author interview talking about the risk of trading. So make sure you head on over and sign up for that webinar. Again, it is free. We are not selling anything, just all about presenting useful information and offering some time for Q&A. If you have any questions on anything that NetPicks offers, feel free to send us an email, give us a call. We'd be happy to answer any questions you have on today's presentation or any of the products that we offer. So Mark, well done. Thank you for joining us. And
hey, thank you for having me. You too. Have a good one.
All right, sounds good. We'll talk to everybody later. Have a great afternoon.